Hi, Eric Neese here. If you've taken a look at Robert Kiyosaki's video and email on their video on the three types of assets, he really boils it down to just three. And those are three types of assets: can be a business, investing in a business, or investing in real estate, or investing in what he calls paper. Now, investing in a business, and as he goes over, and if you haven't watched his video, I really recommend you watch it. Just go on YouTube and put in assets Robert Kiyosaki, and you'll find it. But otherwise, just go to his website. But what you'll see there is these three types of assets. First of all, I agree with him on the first one, a business. A business is probably the hardest. I've been involved with that. I am involved with that. It has, sure, a great deal amount of reward, and it's also has a great deal amount of responsibility. I continue to be involved in one, and no doubt running a business is probably one of the most challenging of all three of those assets, and maybe most rewarding. But anyways, that has its certain challenges, and not everyone has the entrepreneurial spirit or ability to invest in that. But also, when you just look at the assets, one time I just saw these pods that go around, and these new pod thing, and I went on and I was looking at that as an investment opportunity, and just I was curious about it, and you can go look at it yourself, but it had something like $1 million worth of commitment, financial obligation. And that goes with any old kind of store, or any kind of, your wife wants to get together, a boutique or something like that. I mean, you start hiring people and bam, there goes your profit, and all of a sudden you're operating a charity more than a business. And so it's really hard to run those businesses. But not only that, but it takes a lot of capital and a lot of energy and risk that goes into them. So anyways, businesses are great, but they do have their certain obligations and responsibilities and risks. The other one is real estate, and I guess now we've seen with the real estate collapse and what's happened there. Yes, we had a nice run up, but overall, and if you caught that run up, which many of us did or didn't, and many of us are stuck with houses now, but that's great if you caught it. If you didn't catch it, fine, hey, we're going to wait this one out. And that's the problem with real estate, isn't it? It's not very liquid. I mean, you're just kind of stuck with it. In the end, if you can't unload it, I frankly hate to say it, we've had a house and close within our extended family that we haven't been able to sell for, we're going on 5 years now. That is a long time to have a house on the market and be carrying that double mortgage. But anyways, real estate has its challenges, and with that and with any business, you have to know what you're doing. But let's just, before we move off of real estate, let's talk about that one more second. If you look at the lifetime of real estate, it has its ups and downs and peaks and retrenches. But it returns a very nominal 2 to 3% over a lifetime. So in that sense, yes, you get leverage because you're only putting up the small amount of the down payment, and then you leverage it while it's riding up. But really, the return on assets there is generally a very, very small portion, and lower than what you might get on just a standard S&P type of thing. But with real estate, it has its cycles, just like all markets have their cycles. So if you're investing in paper, the third asset, that is also a challenge, because with all these things in business, paper, and real estate, you have to know what you're doing. You have to know what you're doing in business to run a business effectively. With real estate, you have to know to buy good real estate and not the bad one, and how to then run it profitably. And then with paper, if you're trading paper, you can lose a lot of money. A lot of money can be lost in the financial markets, as we've seen now just recently with our so-called safe 401ks. Everyone has been losing a lot. And that's fine. All markets have their retrenches, and hopefully you don't buy at the peak and sell at the bottom. Hopefully you don't do that. But the question becomes, where do you get the financial intelligence to be able to make the right decisions if you're going to be trading paper? What I see and what we see about it is the fact that these financial assets, they provide an opportunity to grow some additional, a little extra something on the side that helps pay for new cars, education, retirement, college, vacations, all those other kinds of things that the daily day job doesn't. So if we can, through our day job and through our normal activities, start to put away and start to put some assets, accumulate assets, even in just financial paper, which as I'm the biggest proponent of, because I don't want to run a business and I don't know anything about real estate. So if we just look at the assets in general, and the financial assets, we start to put some money over there and put it on the side, and we get it to grow. And as you know, that we're interested in trying to grow those at fairly significant rates, over 45% with the minimum would target, so we can get some significant accumulation of wealth and accumulation of those assets that grow over time. And so that's really what we're trying to do here. But more than just trying to grow that, what we're also trying to do is to try to isolate some of the financial intelligence that is required to make good decisions and within those market and within those trades. But also not only just the right decisions in terms of making good decisions, because we don't suggest that we make all of those decisions correct. In fact, we make darn near 50% of them wrong. But what we do is try to eliminate the emotions to control the emotions out of those losses, and then also make sure that we have portfolios of investments, which some are winning and some are losing, and let's just take 50-50 for example. But if our winners far outweigh the size and order of magnitude of the losers, then on average and globally speaking, we provide a return. And as I suggested before, we're looking to provide 45%, and we're targeting 45% returns in everything that we do and what we try to invest. And so if you're interested to learn more about how that can be done, if you want to go buy a business, buy a pods business, get some other kind of chain, get a McDonald's or whatever you want to do, that's great. Go come up with the capital to do those kinds of millions of dollars of capital, go get the loan, and hey, all the power to you. If you want to go buy real estate, sure, there's money to be made there, and there's still money to be made. There's probably a lot of good buys there, but it's not as liquid. What we're doing, and if you want to learn more about what we're doing in terms of the assets and accumulating those assets, sign up to subscribe to the site. It's just here. You can subscribe to the site, and we'll provide you more information on ways that you can do that and how you can get into some of these types of investment products that do target significant returns. Thanks for your interest, and we'll see you on the flip side.